Imagine a future where one technology controls the entire economy. That technology is AI, and right now, trillions of dollars are pouring into it. But here's the question. Is this a historic breakthrough or the biggest financial bubble of our time? More money is flowing into AI companies than ever before. In just a few years, corporate investments have skyrocketed, pushing valuations into uncharted territory. This growth has made some of the world's top investors uneasy. In July 2025, investment firms started warning of a possible AI bubble. By August, Sam Altman, founder of ChatGPT, said AI spending was looking bubble-like. And in September, Mark Zuckerberg agreed, citing similar concerns. To understand why this matters, we need to look at history. 25 years ago, the internet boom created the Dotcom bubble. Venture capital funding surged from $3 billion in 1995 to $105 billion by 2000, a 35-fold increase in just 5 years. The result was a dramatic market crash. Today, AI investments have grown from $103 billion in 2019 to $252 billion in 2024. The scale is different, but the speed of growth is raising eyebrows. Valuations tell another part of the story. During the dot-com peak, the Nasdaq traded at an average of 70 times earnings. Today, it trades at around 35 times earnings, still higher than the historical average of 20. Some AI leaders, like NVIDIA, are valued even higher, at 50 times earnings, and many startups are priced at 20 to 30 times revenue despite having little to no profit. Market concentration adds another layer of risk. During the dot-com peak, tech stocks made up 33% of the S&P 500. Today, just 7 companies, the M87, account for 34%. This means a small group now dominates a massive share of the market. What causes bubbles to burst? History points to 3 factors: high valuations, greed, and rising interest rates. In the late 1990s, excessive valuations fueled by speculation and easy funding created unsustainable growth. When interest rates rose, borrowing became expensive. Funding dried up and the bubble collapsed, wiping out huge amounts of value. Today, the situation is different. Interest rates are falling. In September 2025, the Federal Reserve cut rates and hinted at more cuts ahead. Lower rates mean cheaper borrowing and more investment flowing into AI. This could inflate the bubble rather than pop it, at least for now. Lower rates don't improve company fundamentals, but they do fuel further growth. Valuations and greed remain high. Investors are chasing the next AI giant, pouring billions into startups with lofty expectations. That combination keeps the question alive. Will the AI bubble burst or keep growing? Understanding bubbles also means seeing opportunities. In finance, there's a pattern. Panic leads to overselling. Overselling creates opportunity, and opportunity creates profit. This cycle has repeated itself in history. During the dot-com crash of 2000, the 2008 financial crisis, the 2020 pandemic, and the 2022 market correction. During downturns, fear creates selling pressure, often overselling quality assets. Savvy investors use this to their advantage, buying undervalued opportunities. For example, Amazon fell more than 90% during the dot-com crash, but those who invested then saw massive returns later. The takeaway? Bubbles and crashes are part of market cycles. Over the past century, the U.S. has experienced 16 recessions and around 25 major crashes. That's more than one recession and 2 crashes every decade. The key isn't avoiding downturns, but being prepared for them. AI could be one of the greatest opportunities in history, but it comes with volatility. If you understand how cycles work, the rise of bubbles, the panic, and the overselling, you can prepare to turn downturns into opportunities. When money moves, it creates chances for profit. For investors who know how to navigate cycles, uncertainty isn't a risk, it's an opportunity. The question now is not just whether AI is a bubble, but how you position yourself for what comes next.